to stop you from thinking that there's only one or two ways of making money. There's actually effectively infinite ways to do it.
So, hello everybody. This is Domenic and we've got Adam Geha from EG Funds Management. Now, Adam, I spoke to him earlier today, and it's probably a little less embarrassing me saying it again, but I'm a fan of his for a very long time, and I've seen him as like a faraway mentor. I really, really respect his business. They've been operating, or you've been operating for more than about 20 odd years, and you've got billions under management, 3.2 billion in assets, but then a $2.1 billion development pipeline. That for me wasn't the reason why I wanted Adam on the show. It was, in fact, that when you follow Adam and you talk to people that know him, everybody has a really nice thing to say about him. And you can see that in many ways he feels like a philosopher. He leaves really nice wisdomous notes behind, and you'll always learn something talking to him. So it was my hope to do this podcast, learn something today, and pass on some of your knowledge to our greater audience. So thank you.
Thank you very much. That's a very generous introduction, and I'll do my very best to pass on whatever wisdom I have. I've got to say that you are spot on in describing me as a philosopher. I often say in more confessional moments that I happen to be a businessman. I love it, but my true vocation and my true love is philosophy in its broadest sense. I'm very interested in the question, why are we here? What's the meaning of life? And so I'm interested in philosophy. I'm interested in religion. I'm interested in poetry. And I often look for business people who share a love of those things. There's not that many of us, but there's a few. And I certainly love interacting with people who love business, but also love philosophy, poetry, and religion.
It's interesting. I've been following you on LinkedIn a while, and you leave these very thoughtful notes. And as you said, I don't meet many people in your professional capacity that are so open-handed with their wisdom. There was one particular note that actually made me stop, and I said, "Oh, well, this is when I have to start the podcast, or at least invite you." You said, "Questions are the neck that turns the head. If your head is facing the wrong direction, it is difficult for your eyes and brain to generate the right answer." And it's, it went on to then extrapolate on all of that. How would you appropriate that, or how would you sort of use that in this modern world, and in particular with investments?
Right. In fact, it's a very good question. I wrote today, my blog today is exactly on this. If you care to check it out, it's talking about don't ask the question, is in higher inflation coming, and if so, how high will it be, and if so, for how long? Because these are predictive questions that are very difficult to answer. Ask instead, if higher inflation comes, how will it impact my investment portfolio? And how could I reconfigure my investment portfolio so that it benefits from higher inflation? Questions are very, very important, because the questions that you ask yourself to direct your activities for the day effectively turn your entire body in one direction. So what you see depends on the question you ask. You can literally turn your body 180 degrees by asking a different question. And that's, I think Abraham Lincoln is famous for saying, if I had 4 hours to cut a tree, I'd spend the first 3 hours sharpening the axe. And I think the axe is the question. So sharpen the axe means get the question right. And then you can spend an hour solving the right question is going to help you a lot better than a great answer to the wrong question.
Yeah, and I think that's very interesting. And as you said earlier, the question that you posed today around inflation, I think it's a poignant one, and I'd like to almost point that question back at you.
Right.
We've been talking about for a while.
Yeah, sorry, Domenic. It's a non-trivial risk is the technical term. So exactly what percentage you want to attribute to it, put it this way. there is a material risk that supply side constraints because of COVID, the desire for countries to bring to onshore a lot of the manufacturing capability they were once happy to import, and the printing of money at a scale never before seen, particularly in North America. The combination of those factors is already seeing significant inflationary pressures in the United States. Now, if you're not processing that that's a real risk that it might eventually infect an economy like Australia, you're not thinking straight. There is a risk. I don't see it as above 50%, but it's somewhere in that 20 to 30% range for me. And when a risk rises to that level, it's time to run scenario analysis. It's time to run stress testing on your portfolio. You should go and have a look at how many of your leases are referenced to CPI as opposed to just a fixed number. Now, it has been the fashion in the last 10 years, with inflation running at sub 3%, for people to choose a fixed number like 3 or 4, because they feel that that will help them escalate their rents higher. I would be switching all of that to CPI plus 1 right now, if you can.
If you're just an everyday investor, this is your first time entering the property market, and you're hearing a lot of this talk about inflation. Is there much that you should be doing or thinking about? How do I get ahead of this inflation? What are my risks to me if I'm only sitting in cash, or what investment should I be looking at?
Well, I mean, cash is a very dangerous place to be today, just because there's a huge asset price inflation going on, and you're earning no interest at all. So, look, of course, there are many circumstances where having a large cash balance is appropriate, and not the least of which is if you're approaching retirement and you need to rely on retirement savings to live. You don't want to be taking too much risk with your portfolio at that stage. But I think real assets are a great hedge against inflation, and real estate in particular has demonstrated over a century of data that, be it residential or commercial, has an extremely good track record for protecting you against inflation. And I would have thought, whether it's Sydney residential or you get into industrial or office leases, which are escalated by reference to CPI, they're both great options for hedging against inflation if it should rise to 4, 5, 6% as a result of the forces I mentioned earlier.
It's very interesting to think about that. It's an environment that we haven't experienced for a long time. I've only really experienced one significant crash, and then a couple growth spurts. You've been doing this longer than I have, so you can probably remember a time when interest rates were above 5 or 6%. And is this a consideration now that you're starting to think about? Do you think that we're going to be reverting to a time where we will see interest rates go above 5, 6, 7% again?
There's no imminent threat of that. I think that the abundance of money and the monetary policy settings of the federal government and to re-stimulate the economy, I'm guessing that the Reserve Bank's balance of policy will be towards stimulation, because their concern will be returning people to employment in the post-COVID era, to the extent that we're about to be vaccinated. There are many people. We've had a relatively painless passage through COVID so far, and we should be extremely grateful to good fortune, and also, I think, good government. Nonetheless, the reality is that there's still risks, and what we forget is there are many sectors, like overseas students have not come back, and so all of our universities are in distress. There are industries, hotels that are dedicated largely to business travel and international tourism in distress. So there are still big sections of the economy that are not normal. And so I see there's going to be dislocation in trying to bring those people back into employment. So my balance of risk is still, the way I read the economy is I feel interest rates will probably remain sub 5% for the next 3 years. Beyond that, anything is possible. And I'm not a big fan of trying to predict things because I think the world is inherently unpredictable. And quite often it throws in a variable completely outside what they call an exogenous shock, comes from outside of the known variables that are being studied. And for that reason, I don't spend too much time trying to predict the future. I actually think it's quite a big waste of time because it's in the nature of the future that it is inherently unpredictable. And I'll give you an example of that. My father, who was a developer entrepreneur, we're Lebanese family. I was born in Lebanon. My father, at the time of the Civil War, he had a thriving business, a consulting business in Beirut. He had quite a lot of cash sitting in a bank account, and he had quite a lot of real estate around the country. So he was doing very well. He was around about 40 years of age at this point. And the Civil War erupts. The business is worthless because all of the projects are now suspended. It's not saleable, and it's literally actually got costs and no revenue. That happens overnight. Secondly, the government, there's a run on the banks. So all the cash that he has is frozen. You're only allowed to withdraw the equivalent of $200 a week for groceries. And the real estate portfolio that he owns is not saleable other than at distressed pricing. All of this happens literally within the space of days. And Dad is then forced to make a decision after a few months that to go to Saudi Arabia, start again with no working capital. He literally asks his first German company, which has got a contract to build a hospital in Riyadh, to give him a 10% mobilization fee on the contract, which becomes his working capital. So then he said to me, since that day, he said, I've always kept a portion of my wealth outside of the country of my residence. So he said to me, as soon as you can afford it, put a nest egg sufficient to allow you to resuscitate yourself outside of the country. He said, you may think it's inconceivable that anything would happen in Australia, but he said, you just never know. Geopolitical events can turn on a dime. It's not inconceivable that Australia could be threatened militarily by another country. There could be a civil war event, riots. There could be a biological threat. There could be an ozone layer rupture that makes living in Australia dangerous. Whatever it is, he said, just put away 10% at a minimum of your net wealth outside of the country. It's an insurance policy to allow you to quickly resuscitate and resurrect yourself if you need to in a crisis type event. So that's what I did about 6 or 7 years ago. We went and bought a whole bunch of residential real estate in Austin, Texas, and we've just left it there, just letting it accumulate over time, and we just keep buying, a couple of houses a year. And with a bit of luck, we never need to use it, but it's there if we do.
That's really, really interesting that your father's early lessons have now helped to inform your now investment philosophy. It's very difficult for me to conceptualize that kind of pain and loss, though it's only a generation ago that my parents and my grandparents can tell very similar stories with, their times in Italy and obviously World War II and all sorts of stuff. So I was going to actually ask you about your investment philosophy, because I've seen you talk about two different things. One is obviously this, where black swan events can happen, and then how do we prepare for that? But you also I've noticed you talk about cycles, and you talk about property cycles, normal investment cycles, and being able to rely upon how how investments can normalize over time.
Yes, that's right. Yes, big fan of just to be of to study the long-term pattern of returns, because it's unlikely that an asset will outperform uh, in succession. Two holding periods of say typically 5 to 10 years. So if it outperforms for the first 7 or 8 years, it's unlikely to outperform for the next 7 or 8 years. And what you're really hoping for is either average or sub-average performance before you acquire an asset. And then you've got the law of gravity working in your favor, which is to say that the next 7 or 8 years are likely to be above average to compensate for the last 7 or 8 years being below average.
And would you say that this is your investment philosophy, to be looking for underperforming assets?
Yes, that is one of the. It's one of the narratives. It's not the only one, because you don't want to be a one-trick pony. But you typically, as a successful investor, you want to have 4 or 5 thematics that you feel comfortable in exploring. For us, we have a core competence in urban planning and rezoning. So we'll pay a premium for an asset which we believe has redevelopment upside through rezoning, because we feel we know how to go about liberating that upside. Clearly, looking for an asset that has performed poorly in the past is one of the narratives of saying, well, do we believe we can actually treat this asset with a strategy that's different to the previous owner, and with a bit of luck, have market forces also help us to take the asset to higher ground. We also are active in development. So we'll sometimes buy an asset that's ready to be developed because we've got a development team that can liberate the upside by managing the risks of the development itself. They're just 3 thematics that we use. A 4th one is sustainability. So we quite often look for assets that have got low neighbors ratings. They're not efficient in terms of the use of energy. And we look to improve their sustainability credentials, and then look to market them back to tenants who value sustainability as part of their ethos. So as you can see, we will typically have at any given time 5 or 6 investment thematics to allow us to find enough opportunities. Australia is still a tiny market in commercial real estate. There's only 400 transactions a year that are above $10 million. And we typically we're looking to do something like 8 to 10 of them a year. So, and we'll sell for, say, so in a given year, we'll do 12 deals on the buy and sell side, and there's 800 buy sell. So that's 1.5% of the Australian market in terms of transaction number. So imagine our tiny little company is transacting on 12 of 800 buy-sell transactions in commercial real estate. So that if you don't have lots of strings to your bow, you're not going to do too many deals. So you've got to have
It'd be
more.
very difficult.
Yeah.
And do you think that for the average investor at home, for someone like myself that's not doing large scale commercial transactions, do you think that having an investment philosophy or an ethos or a way to approach your investments is important? And how do you go about developing something like this so that you can have this long-term sort of systemic growth, if you will?
Yeah, I mean, all of the investment literature now suggests that most of the money is made by picking an investment theme as opposed to precise execution. So it's actually more about which board you're throwing the darts at rather than how you're throwing the darts. So as long as you focus on the right darts board, it almost doesn't matter where the widget lands, whatever you call that. So I think for us, picking cities is a very important decision. How did I come to Austin, Texas? Well, I ran through 50 cities in the United States, and I ran through 6 or 7 filters from population growth to GDP growth to employment growth. And then I looked at a host of cultural parameters because I take the view that a successful city is one which has a thriving arts community. So I wanted to invest in a city that that valued live music, had arts and crafts type events and conferences, that had a thriving, sort of outdoor exercise culture. So, and I measured, for example, there's indices that measure restaurants, cafes per capita, music venues per capita. So when I went through all of those, Austin ranked number 1, and I just said, right, I'm putting all of my money into Austin, Texas. What I didn't do is diversify, because I took the view that I didn't have a huge amount to want to split it, so it was easier to manage it. It's a lot easier. We bought something like 20, 25 houses in Austin, Texas, and what that was a lot easier to do is to keep them in the one city, so I didn't have the geographical dispersion, and I did so on an investment thematic. Now, you might say my particular choice of properties could have been better. I don't doubt it. I'm not an expert in Austin residential, but I dare say because I picked the right city, the equity tripled over 6 years. Yeah, and that's all got to do with the high level thematic.
That's really interesting. I often say to people that everything works. And what I mean by that, it's, you can pick your theme, or you pick your road, whether it's you're a property developer, or you're going to subdivide land, or, I'm going to pick income, whatever it is, they all work in different ways. Pick your lane and run it really, really well. But what I found fascinating is how you came to choosing Austin, Texas, and your list of criteria, how you're paying attention to culture, to arts and music, to what's your urban streetscape, what's it feel like from a gentrification almost. It feels like you're looking for the cafes, the bars, and the restaurants. It's a feeling. You're looking for that feeling inside of a city. And I feel like a lot of that can be applied to just buying individual investments, even within, say, Melbourne or Sydney, or, going house to house. And it's fascinating for an investor like us to hear a global fund manager with billions under development using very similar investment criteria to pick, houses in a growing market.
Right. I mean, that's my personal account. We did do some for high net worths who followed us on Austin, and we did very well. We bought some commercial real estate in Austin as well. I'd say, everything works is good. The only thing is, it works if it's done well. So I had a mentor that had a statement that I use. There's more than one way of being right. I think is a good way of expressing that, to stop you from thinking that there's only one or two ways of making money. There's actually effectively infinite ways to do it. But each methodology, if it's to be successful, has to have a sort of a secret bullet, if you like, a silver bullet that allows you to extract value in a way that the rest of the market can't discern. My filter was, I took a bet that music and culture will be correlated long term with popularity of a city and livability, and I feel like that is intuitively sounds right to me. So and sure enough, Austin regularly hits the top 3 most livable cities in the United States.
I really like that. It's an interesting approach, and it kind of leads to my next question. What are you seeing the smart money doing at the moment? What are your investors looking for, and what are they after? Or are they just saying, I'm happy for you to do whatever you want, Adam?
Okay. All right. Well, that's a trick question. I've written a blog about that a few years ago, because I do get asked the question of where should I invest my money, or what would a smart investor invest their money in? And I say, okay, what you've just asked me is, what's the best move in chess? I can't answer that.
Right.
You tell me where all the pieces are, and I can give you one or two suggestions. But until I know where all the pieces are, it's an impossible question. The best move in chess depends on where all the pieces are. And so I say, look, I'll probably need to ask you something. I've forgotten what it is, 12 or 14 questions. Once you answer 12 or 14 questions, I can begin to give you some sensible advice. And they include things like, what is the term horizon for your investment? Do you need liquidity on an annual basis? Do you have money invested currently in real estate anywhere in Australia? So do you have a hurdle rate of return that you need to satisfy? Do you have a preference for capital gains or income? Because you might be a high income earner, so you don't want to receive income. You want it all back-ended in capital gains. What's your risk return profile? Your risk loving, risk aversion profile? So I've written a blog specifically on this, and it's really I think it has a reference to chess in the title, and so my attitude is I can't answer unless I know you quite a detailed, granular level. But to answer it in a very general way, in commercial real estate, a lot of our institutional investors are very much shifting into industrial. It's seen as the darling sector at the moment because of the investment thematic associated with online retail and the need for house a lot of goods and to deliver them at short notice to households. Retail is seen as a troubled sector, though it hasn't had a bad, last 12 months has done quite well, particularly restaurants, who I think are benefiting from the lack of other venues that are open, particularly entertainment venues. So the buzz that we once got from a concert, we're substituting now with an additional visit to a restaurant. And office is I think, returning. I'm a big believer that work from home will ultimately prove to be an inadequate substitute to working from the office. And I've been warning in some of my literature that there will be significant mental health impacts if businesses adopt work from home as a significant alternative. And I think you also lose many of the benefits that occur from collaboration in an office space. So I'm not a big fan of work from home. I am a big fan of remote working, and EG is building, our aspirations to build a series of what we call nature hubs within 2.5 hours drive of Sydney that can accommodate up to 10 of our staff. And then we're encouraging our staff to go together in groups of 3, 4, 5, 6, and work together for 2, 3, 4, 5 days in a nature hub, as a way of, because all of my observation is that people burn out when they don't get regular access to nature. So nature is a really, really good way of helping to replenish people's energy system and to de-stress them.
I feel that there's two really important themes that if I'm listening to you carefully, one is, and I completely agree with you, that humans are inherently social creatures, and there are some, I think, long-term systemic issues that will arise if people keep isolating for long periods of time. And I do believe that people will revert back to offices because all the best things are done with people. You can collaborate ideas, you've got a sense of camaraderie, there's an energy that comes from having a group of people together that are talking about the same thing, and you can achieve much more together than apart. So the question in there is that I take it you believe that we will revert back to people coming back into CBDs, and there will be some remote working, but primarily we will see people come back to CBDs and to major hubs.
Right. I think so. Yeah, I'm a very big believer in CBDs and hubs. That makes enormous sense to me. I've written a blog about real estate being a network asset. Its value is really from what surrounds it. So one should always say buy property in areas which have a lot of smart entrepreneurial people, because they'll do great things with their real estate, which will very directly benefit yours. And if you buy property in an area, say where the council is unimaginative, anti-development, anti-entrepreneurial, then inevitably your property will languish. So you want to be in areas that are dynamic. You want to be in areas that are changing, and you benefit from the creativity and smarts of your neighbors. And that is a very good thing to do, both in real estate and in life. You know, when they say that you are sort of the average of the 7 people you spend most time with, um, that's true of real estate. I mean, the 7 properties that are closest to you will have a very significant impact on the value of your property.
And I think that's really interesting. I just recently bought a house 3 hours outside of Sydney for the reasons that you're just describing. It's an area that is evolving. You can culturally see the changes that are happening there, and it's even the little things like, sorry,
Where is it?
Nelson Bay.
Ah, lovely area. Yeah, you can't go wrong.
It's silly little things, but I like to go into the center of town and see who's doing the coffees. Is there a cool bakery? Is there a nice bar? And every time I've gone there, there's this one bakery. They always sell out of their Anzac biscuits, and everything's gone. And what I take from that is I'm seeing a real cultural shift. There's a real culinary delight when you go there, and you can see there's an artistic vibe in this city, and I feel like it's going to change. Now that actually leads to my next question, which is, with this severe lack of connection and the fact that we're not seeing as much tourism, do you think that we should anticipate an elastic rebound and seeing a huge tourism spike when the borders do open up? And do you see there being an impact on the different areas that are impacted by tourism and that commercial trade and activity?
Oh, I mean, I think, I don't know whether I've written about this, but I certainly see that there will be a sort of a post-COVID binge that's going to happen. The number of people that I've spoken to that are, just chomping at the bit to travel overseas, be it to go and visit relatives, or direct family, or just simply to take their kids to see the Eiffel Tower, or the Colosseum, or whatever it might be. I can assure you there will be a massive rush on international tourism as soon as the borders permit. And I think music concerts are desperate to do more of as well. And so I think there will be a kick to the economy once the international borders open. There will be a binge, a consumer binge. I know that my son, who's 11 years of age, is petitioning me to take him to Japan or New Zealand to do some snow skiing because he loves snow skiing. He's also asked me, he's interested in going to see London. He's obviously seen a video or two. So he said, I would really like you to take me to the UK. And I'm saying, mate, I'd love to. I mean, the idea of international travel with my kids really, I really look forward to it. In fact, it's one of the joys of parenting is to travel around the world with your kids. So yes, I believe there will be, as soon as the Western world is largely vaccinated, I think we will see world GDP go up by 0.5% just because of this post-COVID binge.
That's fascinating, and I look forward to that day. Talking about your children and the fact that you are, as just to bring it full circle, you are a bit of a philosopher and it strikes me as quite a teacher. Is there, have you got some words of wisdom for new property investors, for people that are entering the market, and ways that they should be thinking about investing or building wealth? Have you got any sort of little tidbits or bits of philosophy or even tactics they should be adopt?
I mean, again, I know I'm sounding like a broken record. General advice is useful, but it's very limited because the individual circumstances can vary significantly. But if I was, I spoke to somebody today for lunch, and they've got $250,000, and he said to me, what should I do? I'm looking to buy my first property, and I said, you can either for that sort of deposit get a nice 2-bedroom unit he's in Wollstonecraft. I said you probably could get a nice 2-bedroom unit with that sort of deposit. You can buy something for about $1 million, or you can get a rather crappy 3-bedroom. And he said, what should I do? And I said, well, you got 2 kids. Ideally, you want 3 bedrooms, but from an investment point of view, you'd be better off buying in a better building and a better suburb, a 2-bedroom unit. From a capital growth point of view, that makes more sense because you're living in it and it's capital gains tax free. It's your primary residence. So I'd go for the nicer 2-bedroom unit because it's going to have better long-term capital growth. And so he took that on board, and we're now sort of helping him just as a friend to sort of find the right property, just purely as a freebie. And so that's that's at a very granular level, a tactical bit of tactical advice. If I was to say philosophically, investing, I often say to people, the first $1 million of your wealth invested in real estate, preferably residential, because everybody understands that asset class. Invested in the city of your residence so that you can at any time. If anything goes wrong with it, you can take immediate control of it. And make sure that you're investing it close to infrastructure. I mean, it's not complicated. What you want is social infrastructure in the way of schools and hospitals. They're the dominant, draw cards for families. And transport infrastructure, mostly that it has great rail and road access. If you get that right and you stay largely within the sort of 10 to 20 kilometre zone of Sydney, you can't go much wrong. Sydney has had an extraordinary track record of delivering 7% capital growth in the case of houses per annum on average for 70 years. I mean, it's extraordinary. As a city, it just keeps performing. And every time doomsayers come out and say, it's the end, it's going to come crashing down, it goes on and rises again. And in my view, I've now reached the view that Sydney residential is driven by lifestyle rather than economics, and that it's such a livable city and such a beautiful city that it will continue to attract a loyal international following. And I predict that luxury real estate in Sydney will do extremely well, increasing, because the rich and famous from all over the world will want to have a luxury property here.
That's brilliant. Adam, thank you very much for your time today. I know that you're a busy man, and we're probably going over time as it is.
It's a pleasure, Domenic. It's very nice to meet you, and I very much enjoyed talking to you. And I think you've done exceptionally well to build the following that you have in the time that you've done it in. And I love the fact that you dig what you do and you actually practice what you do. So you're living the advice you're giving. You're 32, did you say?
Yes, 33 in September.
Yeah, amazing age. I mean, to be doing what you're doing at 32, the world is at your feet. I'm just turned 50. You've got an extraordinary journey ahead of you, given where you have managed to put yourself so well done. And wish you the very best with your podcasting and your investment career.
Thank you very much, Adam. I really appreciate it. It's good to get some perspective from a person that's been there, done that.
Mm-hmm. Well, I feel I've got a bit more being and a bit more doing ahead of me, and I look forward to sharing the journey with you. And I'll be watching your progress with great interest, and you can be sure I'll be cheering for you.